All right, let's talk about building something from the ground up, a data-driven trading strategy. Today, we're going to walk through the playbook, the step-by-step process that can take a simple observation about the market and turn it into a solid, testable, and real-world plan. Let's dive in. So, let's just start with the big question right off the bat. Is successful trading just a game of luck? A coin flip? Are you just hoping for the best? Or is there a way to build something that actually has an edge, something you can repeat and rely on? That's really the core problem we're trying to solve here. And this really lays out the two different worlds, doesn't it? On one side, you have guesswork. It's emotional, it's chaotic, it's driven by gut feelings, and honestly, it's incredibly risky. But on the other side, you have a system. It's based on data, it requires discipline, and because of that, it's robust, and this is the most important part, it's testable. We're basically moving away from just winging it and toward a more scientific approach. That brings us to Act 1, crafting the blueprint. Think of this as the foundation for everything that comes next. This is where we take a fuzzy idea about the market and start shaping it into something solid, something we can actually build on. Now, this blueprint really boils down to two critical steps. First, you gotta do your homework. That's market analysis and getting your hands on good, clean data. You can't build a solid house on a shaky foundation, right? Same deal here. Second, you form a hypothesis. This is where you get specific about the market behavior you think you can actually profit from. A strong hypothesis isn't just a vague feeling like, oh, I think momentum is a thing. No, it's about defining that with laser precision. For instance, if a stock closes above its 50-day moving average for 3 days in a row, I'll buy it. I'll sell when it closes back below it. See? It's specific, it's measurable, and now it's something we can actually test. But you have to be careful because this first stage is just riddled with traps. Using bad data, for example, is going to poison the entire well from the start. Same goes for cherry picking, only looking at the charts that prove you're right. And maybe the biggest trap of all is having a vague idea. If you can't test it with a clear yes or no, it's not a strategy, it's just an opinion. So, once we've dodged those traps and we've got a solid blueprint, we move into Act 2, the trading lab. This is where we forge our idea into a real strategy, and then we do everything we can to try and break it. The lab process is very methodical. First, we write down explicit rules for absolutely everything. Entry, exit, how much to risk, no gray areas allowed. Then, we backtest it. We run our strategy on historical data to see how it would have performed in the past. And finally, we tweak it a little to optimize it. And then, this is crucial, we test it for robustness to see if it can survive when things get weird. Backtesting is where we get the cold, hard numbers. We look at stuff like max drawdown. That's the biggest drop your account takes from a peak. It tells you about the kind of pain you might have to stomach. The Sharpe ratio basically asks, are the returns you're getting worth the risk and the roller coaster ride? And the profit factor is simple. Are your winning trades big enough to more than cover your losing trades? These numbers turn our idea into a real performance profile. But here it is. The single biggest danger lurking in the lab: over-optimization. It's also called curve fitting. This is what happens when you tweak and tune your strategy so perfectly that it looks like a masterpiece on past data. But it's been tailored so specifically that it has zero ability to adapt to a future it hasn't seen yet. It's perfectly captured in this idea you're creating a strategy that's perfect for the past, but totally useless for the future. You've essentially drawn this beautiful, incredibly detailed map for a country that doesn't exist anymore. It's a work of art, sure, but it's completely useless. So how do we avoid that? Well, the antidotes are all about stress testing. With walk-forward analysis, you optimize your strategy on one slice of history, and then you test it on the next slice of history that it's never seen before. Monte Carlo simulations will literally shuffle your trades around thousands of times just to see if your great results were because of the strategy or because you got lucky on a few big winners. These tests are designed to find out if your strategy is the real deal or just the historical fluke. All right, now for Act 3, entering the real world. Our strategy made it through the lab. It's been built, tested, and stress tested. Now it has to face the final boss, the live, messy, unpredictable market. The road ahead requires some patience. First, we forward test, which most people call paper trading. This means you run the strategy in real time, but with a demo account. Fake money, but real market data. It's the ultimate dress rehearsal. Only after it proves itself there do you even think about deploying real money. And even then, you start small and scale up cautiously. And listen, this is not a weekend project. The recommended time for paper trading is somewhere between 3 to 6 months. Now, why so long? Well, because you need to see how the strategy handles different market moods, not just a calm, quiet week, but during crazy high volatility, during big news events, you need to gather meaningful data. And even here, right at the finish line, there are still traps. Cutting your paper trading short is a huge one. So is getting overconfident and just throwing your whole account at the strategy on day one. But the most dangerous trap of all is psychological. It's letting your own fear and greed make you ignore the very system you spent all this time building. Which brings us to the final step, which isn't really a step at all. It's a never-ending cycle. See, the market is always changing, always evolving. A strategy that you just set and forget is a strategy that's pretty much guaranteed to fail eventually. This whole thing happens in a constant loop. You're always monitoring your performance. You're analyzing your trades, what's working, what's not. You make small, careful adjustments to your rules without, changing the core idea. And then you just repeat the cycle. It's a process of constant adaptation. So, what's the big takeaway from all of this? It's that the goal isn't to find some mythical, perfect strategy that works forever. That just doesn't exist. The real goal is to build a perfect process, a systematic, data-driven, and disciplined way of creating, testing, and managing strategies for the long haul. The only question is, are you ready to build yours?